Big M&A deals, new records in gold and silver, industrial metals break out, battery metals turning heads. Wait till you see the price of lithium. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli, and what a show we have for you today. So as I've been saying here on silver, waiting for the smoke to clear to find out what's going on. So I brought on Jeffrey Christian to help give us some insight and some perspective. One of the big experts really in the gold and silver market globally, managing partner at CPM Group, consultant to central banks, governments, and more. So a delight to have Jeffrey Christian on the show to get his perspective on a day yesterday when gold and silver were breaking new records. So I can't hope for more than that. Of course, the very big news is Rio Tinto's bid for Glencore in the last week. Of course, Rio Tinto, the second largest mining company, bidding on Glencore, and together they would make a $207 billion mega miner, according to Reuters. So we're going to take a look at that, and that would knock out BHP, which is currently the top miner. And increasingly, as one of the headlines says, they look like they're sidelined here as M&A continues. So we're going to take a look at that later in the program. What I wanted to start off with is a story that really turned my head, which I'm not seeing much talk about. I'm curious your thoughts. Feel free to write a comment on YouTube is probably the best place to put it. So let's take a look here. China's metals in grip of frenzy as investors bet on rally. This is Bloomberg News via mining.com on January 7th. China's metal markets are in the grip of a speculative frenzy, with trading values in Shanghai surging more than 260% from a year earlier, as traders and deep-pocketed funds pile into commodities like copper, nickel, and lithium. And again, we have broken $20 per kilogram on lithium. Just to give you some sense, nickel, we are above $8. We will get to that. Let's continue here. Open interest has surged to a record across the 6 base metals traded in Shanghai, pointing to robust sentiment as investors bet on global supply tightness, resilient industrial demand, and a more supportive interest rate backdrop in China and the United States. Heightened geopolitical risks have added to the rush into raw materials. The total turnover of the Shanghai Futures Exchange's 6 base metal contracts plus gold and silver futures reached 37 trillion yuan in December, equivalent to more than $5 trillion. By trading volume, December 29th was the single busiest day for copper in more than a decade. And then there is a chart that you see from the Shanghai Futures Exchange, courtesy of Bloomberg. And they have the metals listed: copper, zinc, nickel, tin, lead, and aluminum. And almost all of these metals are doing quite well. Perhaps lead and zinc are the most muted, but still doing well. But, copper, records. Nickel looking like it's seriously bottomed. Aluminum at prices we haven't seen since the beginning of the Ukraine war, when prices shot up. So it brings back a theme that I keep returning to here, which is the increasing influence of China on the price of metals. And as I was saying last week, one thing is to see it going on in gold and silver, monetary metals, as Jeffrey Christian puts it. It's a whole other kettle of fish when copper, nickel, and aluminum start moving higher. As I said last week, look around you. How much gold and silver do you see? I hope for your sake, a lot. But for most of us, not that much. And then ask yourself, how much copper, how much aluminum, and how much nickel do you see around you? And you start looking at your TV, you start looking at the lamp, maybe you're looking at your heating device if you're over here in Europe, and you're starting to see more industrial metals. And so when we think of inflation and when we think of impact, of course, gold and silver matter. But it's a whole other story when, as that U.S. Senator beautifully put it, when these building blocks of the supply chain start to get significantly more expensive. This has a big impact, and then putting silver, which is also an industrial metal, on top of it, when you start adding that into the mix, what does that mean? As Jeffrey Christian puts it, we already have 2 Chinese solar manufacturers announcing a transition away from silver towards copper. a story I read here last week. So let's continue here. Let's see what else it says. As well as the general supply tightness, metals are finding support from monetary easing by central banks. Lower interest rates typically encourage investors to buy non-yielding assets like metals. A weaker dollar is also a tailwind, with investors piling into the so-called debasement trade. Now, this is a whole other matter because, of course, we saw the news yesterday, perhaps Sunday evening, where Jerome Powell may be brought up on charges where there is increasing pressure on the central bank to lower interest rates. How can the Fed lower interest rates when base metals are going through the roof? How does that work? And we have a quote from Jia Zhang, head of trading at Shanghai Suzhou Jueying Investment Managed Company. Quote, we've seen significant macro allocation flows into commodities. End quote, adding that some equity funds are betting commodity futures will rise alongside stocks this year. Nickel, used in stainless steel and batteries, advanced nearly 6% on the Shanghai Futures Exchange on Wednesday. The most active aluminum contract closed at its highest since 2021, while copper has shot beyond a milestone 100,000 won a ton, defying some bearish signs in the local market, including rising inventories. Turnover on the Guangzhou Futures Exchange, including lithium, palladium, platinum, and silicon futures, was around 5.6 trillion won in December. This was more than 6 times higher than the same month in 2024, although some of the Guangzhou contracts are relatively new. But questions remain as to whether the scorching rallies have run too far too fast. As the bull run accelerated in the second half of the year, some of the new capital invested was speculative, said Chi Kai, Chief Investment Officer at Shanghai Cozine Capital Management Partnership. Quote, the market will test trading skills, he said. Easy profits won't come simply by holding positions, and the risks are increasing. Volatility is becoming an increasing risk, especially in Guangzhou, where a platinum contract launched at the end of November has already traded either limit up or limit down on 8 occasions. So if I understand this correctly, a platinum contract launched in Guangzhou at the end of November, before we started seeing all the wildness in the PGMs in December, has already traded either limit up or limit down on 8 occasions. So, I'm kind of back to, what are the implications of this? What does this mean? And it kind of goes further than that. I mean, if you're a government, if you have reserve currencies, as Cam Curry says, we have the US dollar as a reserve currency, and as he says, the euro is a reserve currency and gold is a reserve currency. Increasingly, I'd be curious, we should bring Cam Curry back on the show. You wonder about the won being a reserve currency, because if you can start buying commodities with your currency, I mean, are we not at the point where you can print money and get real things for it? I mean, don't you start to become a reserve currency? And if it doesn't meet the technical definition in theory, perhaps in practice, it does. Because at the end of the day, if you can print money and get real things, it seems to me you want to do that. And then if we want to go more speculative, as we enter what is increasingly being called a commodity war, and you have to give the gold bugs their due, in the sense that they are often, you might say, directionally right. We might say the rationales can sometimes, in some cases, oftentimes be called into question. But overall, the gold bugs, we have to admit, we have to concede, have been right. Gold has gone to almost $5,000. Silver has blown up, right? So there does seem to be an issue with fiat currency, increasingly so after what we saw this weekend with the Federal Reserve. Then the question becomes, if you get speculative, if you're China and you have all these state-owned enterprises, why aren't you just funneling money into these state-owned enterprises to buy as much metal as you possibly can, while you can? Because it doesn't look like it's going to get any cheaper from here, does it? Because right now it seems like we're hitting a bottleneck of sorts of supply. So it seems to me the rational thing to do is say, if you have a reserve currency, you buy it while you can. And if you don't buy now, when do you buy? This is the question. And we've heard, now the US we've heard of stockpiling. We've heard the EU talking about stockpiling. And we've heard China has long stockpiled. So these are the sorts of thoughts I have here when I see an article like this. So let's just finish it off. From mid-December, the Guangzhou Bourse also capped new positions and raised fees for lithium carbonate after the contract rallied 35% in the space of around 7 weeks. Though open interest has retreated since then, it remains at a historically elevated level. The most active lithium futures contract rose 4.5% on Wednesday. And so some of you might be wondering, how can you not start with Rio Tinto and Glencore? That's such a huge story. This is the big story. Industrial metals. Again, I say look around you. This is the story that will hit you. Whether Rio Tinto and Glencore merge, how much is that going to make a huge difference in your life? But this Chinese investment from Guangzhou seems to be, pretty influential on what's happening in price here. Finally, the Shanghai Futures Exchange will also raise the trading margin and daily price limit for some silver futures from Friday, according to a statement from the exchange. The Bourse urged investors in a separate statement to invest rationally, citing recent developments that have caused volatility in metal prices. With base metals starting the year strongly, copper hit a record on the London Metal Exchange earlier this week, and the LME index that tracks the 6 main metals surged to the highest level since 2022. Chinese investors are likely to stick around. This is reinforced by the presence of macro funds, which tend to hold their positions longer. Shanghai Sucho's Jia said, quote, looking ahead to the next 6 months under the broad backdrop of monetary easing in China and the US, macro capital is unlikely to exit, she said. So that is our opening article here. Here are some headlines. This is Bloomberg News via Yahoo Finance. Aluminum hits $3,000 for first time since 2022 on supply concern. Aluminum climbed above $3,000 a ton for the first time in more than 3 years on a tightening supply outlook and long-term demand bets, joining other base metals notching recent milestones. A cap on Chinese smelting capacity and constraints to European production due to higher electricity prices have chipped away at global inventories, while the demand outlook from the construction and renewable sectors remains robust. Futures rallied 17% last year, the most since 2021. Copper also resumed gains Friday after capping the biggest annual gain since 2009 on tight supply, while nickel jumped after PT Vale Indonesia halted mining following a delayed approval to a work plan from authorities. So, for aluminum, it is a cap on Chinese smelting capacity that has constrained output. And wasn't there another smelter that was supplying Europe that also had issues? A few more massive headlines here. China's threat to block rare earths has put Japan on high alert. So, from my understanding, Japan has not taken back its declaration that it would intervene should China attempt to take Taiwan. And it's quite interesting because all we're seeing here is a steady step change in Japanese bond yields. Once again this week, what were we at? I think we're at 2.15%. I wonder to myself, how much of this is China? Surely they have Japanese bonds, because what I see is just a steady increasing of pressure on Japan here. And here is the story from the New York Times. China's threat to block rare earths has put Japan on high alert. This is by River Akira Davis, reporting from Tokyo on January 7th. Tokyo is concerned at signs that Beijing may be laying the groundwork to restrict access to the metals vital to manufacturing. China's Ministry of Commerce said it would ban the exports to Japan of all dual-use items with potential military applications, citing national security concerns. The official announcement, issued on Tuesday, was vague on specific commodities. Government-affiliated media, however, said Beijing was considering whether to include certain rare earths among the items it was restricting. The state-run China Daily reported that authorities were considering more stringent reviews for licenses to export so-called medium and heavy rare earths, scarce groups of metals found in devices ranging from electric vehicle motors to missile systems. So it sounds like China just keeps warning Japan, take it back. Take what you said back. And Japan is refusing. So it looks to me like it's just going to continue until Japan relents. Shortly after the ministry's announcement, the former head of the state-affiliated Global Times said on social media that a suspension of rare earth shipments quote, would strike an exceptionally broad range of industrial sectors, and that, quote, the possibility that anything could happen cannot be ruled out. It sounds like a warning, doesn't it? Now, meanwhile, Japan set sail on rare earth hunt as China tightens supplies. So there has been this story that has been around for a few weeks now, perhaps even months, about rare earths off of Japan's shores under the water. And this is Reuters via mining.com yesterday. A Japanese mining ship departed on Monday for a remote Coral Atoll to probe mud rich in rare earths, part of Tokyo's drive to curb its reliance on China for critical minerals as Beijing tightens supply. So, of course, Japan has faced this in 2010. They have diversified somewhat through deals with Lynas in Malaysia. And of course, this is feeding directly into this G7 meeting, which we're going to talk about in the news section. And then interestingly, this is yesterday on the Financial Times, Japan's Prime Minister Sanai Takaichi weighs calling snap general election. Poll could come as soon as next month as leader seeks to turn popularity into parliamentary majority. So perhaps this is the issue. Perhaps the Prime Minister's policies are popular, and so perhaps being egged on. And this is by Leo Lewis at the FT. Japan's Prime Minister Sanai Takaichi is considering calling a general election as early as next month, according to ruling party members, as she seeks to use her sky-high approval ratings to reclaim her party's parliamentary majority. So, meanwhile, it looks like industry is about to be cut off of essential supplies that feed the economy. Bond yields are shooting through the roof, and the Prime Minister has sky-high approval. So go figure. And also, just finally, on Venezuela, Trump threatens to sideline Exxon from Venezuela's oil, quote, they're playing too cute. You know, I was thinking about this just the other night. I woke up in the middle of the night and I thought, how on earth are these oil companies going to go into Venezuela? After 15 years of preaching ESG, after 10, 15 years of people demanding that they follow, ESG guidelines. And can they just throw that out the window and say, hey, no problem. We're going to throw the social out the window, basically taking another nation's natural resources, and it's so early. So much could go wrong. Rick Rule has stated publicly, repeatedly, Exxon is the greatest allocator of capital basically in the world, to paraphrase. So is Darren Woods going to go out into this super uncertain situation in Venezuela and say, yeah, we're going to start building and we're going to start allocating, tens of billions of dollars to this project right away? Doesn't sound like a great allocation. This thing could turn overnight. It's still very new. It's probably more of a wait and see at best for Exxon. So I wonder, when you get into the back rooms at these giant U.S. oil companies, surely ESG is being discussed here. We might think ESG is out of style, but surely, it has been drilled in to the resource industry for near a decade that the industry needs to care. It has to be a good corporate citizen. They have been programmed. So is that all just going to be thrown out the window at the first opportunity to profit? It seems like a pretty risky endeavor, doesn't it? And finally, an op-ed in The Hill. Just a headline, the U.S. must take Greenland, whatever the cost. This is John MacLeon, opinion contributor. So this is becoming a mainstream view. Whereas 6 months ago, this was not a mainstream view. Now we're starting to see pretty regular discussion. Quite an interesting lesson in narrative, and what seemed impossible when Trump took office, this notion of Greenland and how crazy and absurd it was, is now being discussed pretty seriously by pretty serious people. And this headline is just another example of how the narrative can shift. It's kind of a lesson in Trump's ability to shape the narrative, which is interesting in itself. So with that, we have a wonderful interview with a true expert in the gold and silver markets, Jeffrey Christian, managing partner at CPM Group, one of the most experienced and knowledgeable people in precious metals. We go deep on the silver market, as well as the recent news with the Federal Reserve and potential charges against Jerome Powell. Also coming up, we have a wonderful interview with Lori Clark, CEO and founder of Onion, Onyen, and she discusses her incredible software for companies who are looking to increase their credibility so that they can raise money easier. Fascinating interview coming right up. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. Find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Lori Clark, CEO and founder of Onion, for this week's Spotlight. Joining us today, I'm very pleased to welcome to the Northern Miner podcast for this week's Spotlight, Lori Clark, CEO and founder of Onion. Lori, welcome to the show.
Thank you very much. It is a pleasure to be here. Happy New Year.
Happy New Year to you as well. It's great to have you on the show. I was looking at your bio, RBC's One to Watch Entrepreneur Awards. Can you give us a little bit of background on Onion and what you're working on right now?
Absolutely. Thank you very much. Onion Corporation is one of the fastest growing risk, compliance, and sustainability reporting technology companies in Canada. It's driven by AI, and we started with AI well before it became sexy to be AI. Because of my background in the capital markets and having had AI technology platforms prior to this, the present Onion platform, what it does is it gives companies of all sizes the ability to manage complex reporting obligations, okay? And it's from a financial compliance, modern slavery, to sustainability metrics, to carbon accounting. What it does is Onion serves industries, including not only resource and extractives, but also energy, finance, healthcare, agribusiness, manufacturing. It gives them the ability to unify compliance, sustainability, and risk reporting into one intelligent system. And what it does is it simplifies regulatory obligations. It enhances transparency. It strengthens trust with regulators, investors, stakeholders, absolutely critical to the extractives industry. And what it does is it moves beyond reporting as a cost burden. It actually transforms that premise into a strategic asset. So it improves credibility. It accelerates access to capital, and it drives long-term value creation.
Okay, excellent. So I assume then this would be useful, say, for an exploration company. How would that work? Like, let's say I'm an exploration company and I want, credibility in terms of what I'm doing from a social point of view. Maybe if I want to borrow money, how does that work for me?
Okay, so excellent question. Obviously, with mining and in various industrial companies, it's about permits, financing, insurance, counterparties, the cost of capital. So it's about capital risk, okay? Lenders, insurers, offtake partners, and regulators expect clear, defensible data. This hasn't changed. The language surrounding it may have these days, but the underlying due diligence that these institutions perform will never change. And therefore, being on our platform gives you the real credibility, the real numbers, because what we've done is we've gone out and with our algorithms, we understand what these lenders want in numeric, empirical, concrete ways. Okay, this isn't just a pie in the sky type of reporting. And the worst thing you can have is inconsistent, unauditable, and unverifiable information. Okay, that leads to what everybody, is espousing as greenwashing. That's the real risk today, is bad data, not disclosure. So what the companies that are on our system do is when we're grabbing the data from their systems internally, be it social, be it environmental, be it, SOX data, financial data, what is happening is that we are then confirming against the algorithms that we're running against the financial institutions. We can see the gaps immediately. We can tell immediately whether it's real data or whether they're making up the numbers, frankly. It's a real way of tracing back, especially in mining, whether or not they're meeting the due diligence, results or not. I'm going to give you an example. We have a company right now on our system, and they've been on it since the beginning, in 2022, when we came on very, very noticeably in this country and around the world. And it was because of the fact that we had this ability to pull in what the financial institutions want. Okay. So we were tracking with our algorithms, we were able to track what they need to see. And not just by the standards, the global standards, and what have you. We're talking internal results, okay, from them. And this because of the fact in my background, I used to be a trader on the TSX, but also we used to build trading systems and securities exchange systems. So we have the algorithms already built that can track a lot of information from these financial institutions around the world. So what this company did is they wanted to meet a particular capital raise. Okay. They needed $100 million. This $100 million was not easy to get, especially in the past few years when it's been absolutely abysmal. The markets have been abysmal for the extractives community. Right now, they are enjoying an extremely positive market right now. Gold and silver is up, platinum is up. Right now, everybody's looking at lithium again, cobalt as well. You've got a lot of eyes on these types of critical minerals. However, past years, it's just been a slog for this industry. So what we did is with this $100 million raise, which it took them 3 years, they got onto our system. And by meeting the requirements of the financial institution that they were dealing with and other private equity stakeholders and also other institutional players, okay, because they had family offices, they had banks, they had private equity, they had all sorts of stakeholders at the table that they were trying to raise funds with. And they finally closed. And it was only because of the report that we transmitted back to their stakeholders, okay, their financial stakeholders, that they were able to close the deal. And that's just one of many examples. And that's when I know what we're doing matters, because it is the lifeblood of these companies to be able to do what they do, and they need to raise capital in order to do it.
Okay, excellent. So in other words, you are getting all the ducks lined up in a row for all the credibility requirements that, say, a financial institution, for example, might need before they invest. It's not like the company has a meeting with the financial institution and then they have to do everything. You preempt that whole situation.
Exactly.
So all the ducks are lined up and then all of a sudden it's streamlined, the whole process.
Exactly. Like serious operators are integrating this into enterprise risk. It's not just, as I keep saying, it's not a tick in the box exercise. It's just like, for example, if you want to be on the NASDAQ or you want to be on the exchanges in the States, you have to do what's called a SOX compliant report, okay, an SOX. This came through after the 2008 financial disaster that we experienced. So there are companies that have to perform these, and they're like control reports. They identify if there's any kind of fraud going on within your company. This other report, this sustainability report, what it does is it provides real data, real due diligence back to the financial company that identifies if there's any kind of a gap, any kind of an alert that will say to them, hey, wait a minute, maybe we shouldn't invest in this company. Maybe there is stuff going on here that we've got to be careful about. And what it does is it gives you also a disciplined approach on reporting and identifies the areas in your company that you have to attend to, that you have to perhaps better manage. Perhaps, the way that you deal with certain staff within a particular country, whether you have to do better in that area, or you have an area of water management that there's a problem there that you have to address. It will identify these areas of concern very immediately through our algorithms, through our models, and it is very empirical. There's no fluffy nonsense about it. This is, very technologically hard evidence.
You mentioned $100 million, for example, a company raising. Is this for big and small companies then?
Absolutely. We have from exploration right through to the majors.
Okay, excellent. Thank you, Lori. This is fascinating. And so if people are interested in the product and what you're offering, what should people do?
They can absolutely reach out and contact us at sales@onion.com. That's simple. And if they want to reach out to me directly, they can do so at lori.clark@onion.com. And we would be very pleased to talk to them about their compliance and capital raising needs, because it's about ultimately accessing that capital or alternative capital, because it is the lifeblood of the mining and extractives industry.
Okay, excellent. And that's Onion, ONYEN.com. Lori Clark, CEO and founder of Onion, thank you for joining us and telling us all about what you're working on at the company.
Thank you so much. It was wonderful to be with you today.
Thank you once again to Onion for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit onion, ONYEN.com. Turning to the website, Rio Tinto and Glencore hold buyout talks to create $207 billion mega miner. This is Reuters via mining.com on January 8th. Glencore and Rio Tinto said late on Thursday they were in early buyout talks that could potentially create the world's largest mining company with a combined market value of nearly $207 billion. Global miners are racing to bulk up in metals like copper, set to benefit from the global energy transition, and that has sparked a wave of project expansions and takeover attempts. London-listed Anglo American and Canada's Teck Resources are nearing the finish line on a merger to create a $53 billion copper-focused heavyweight. The discussions between Rio Tinto and Glencore about combining some or all of their businesses are the second round of talks in just over a year between the two companies after Glencore approached Rio Tinto in late 2024, but a deal did not proceed. The two companies said one option would include an all-share buyout of Glencore by Rio Tinto. There was no certainty that the terms of any deal or offer would be agreed upon, the miners said after the Financial Times first reported the revived talks. The U.S.-listed shares of Glencore were up 6% after the talks were confirmed, but Rio Tinto's Australian-listed shares fell as much as 6.4%, the biggest intraday fall since July 2022 against a broader positive market. And we have a quote from Tim Hillier, an analyst at fund manager Allen Gray, which is a Rio Tinto investor. Quote, "There is a risk Rio could overpay. It comes down to price, but if they have to pay a big premium, there's a risk that a transaction could destroy some value for shareholders. Rio has a strong pipeline of internal high-growth projects. It's not clear why they need to look externally for things to do." And you wonder, to Tim Hillier's point, the thought did cross my mind. Is this simply a we want to be the biggest type situation? Under UK takeover rules, Rio Tinto has until February 5th to make a formal offer for Glencore or say it will not proceed. Rio Tinto, the world's biggest iron ore miner, has a market capitalization of about $142 billion. Glencore, one of the world's largest base metal producers, is valued at $65 billion as of its last close. The transaction would be the world's largest ever mining deal if completed, according to LSEG data, and the market value of the combined company would top Australia's BHP Group at $161 billion. BHP shares were up 0.6% in early Australian trade on Friday. So, no reasons given as to why this should happen yet. Let's take a look at another story. Rio Tinto's bid for Glencore piles pressure on BHP. This is Reuters via mining.com on January 11th. Rio Tinto's talks to buy Glencore and create a new global industry leader could spur consolidation efforts across the copper-hungry mining sector and heap pressure on BHP, currently the world's biggest miner, to respond. If the bid succeeds, and depending on any final value, it could rank among the biggest 10 M&A deals yet, and it reflects an appetite for scale that bankers have said could drive mega deals in 2026. So an appetite for scale. Quote, "This is yet another example that the mining space is consolidating and the big firms are being forced to do corporate action to create value," Mark Kelly, CEO at advisory firm MKI Global, said. Frankly, this seems like a pretty risky thing to do in boom times. Last September, London-listed miner Anglo American announced what was then the sector's second biggest M&A deal with a plan to merge with Canada's Teck Resources and forge a new global copper-focused heavyweight. The deal awaits regulatory clearance. Half a dozen analysts, investors, and bankers told Reuters that BHP, which has a market capitalization of $161 billion, is the most likely spoiler of Rio's bid talks with Glencore, which could create a company worth almost $207 billion. If BHP keeps out of current talks, it may consider another deal to retain its leadership. So it's quite interesting. What is the point here? Is it simply to be the biggest? Is bigger better? Is the underlying question that doesn't seem to be asked here. One banking source who spoke on condition of anonymity said that was the most likely outcome given the company views Glencore's portfolio as too diversive and would benefit from asset sales. Regulatory authorities would almost certainly require some disposals to ease competition concerns. BHP declined to comment. Quote, the most likely interloper to this deal is BHP, said Richard Hatch, analyst at Berenberg. Quote, essentially with the deal driven by copper, we think that BHP could look to acquire Glencore with a rival bid, keep copper, and likely divest the balance. Scrolling down, quote, BHP has a cleaner growth profile in copper than emerged Rio Glencore, so I don't think they need to do anything, said Ken Pecker, an analyst at RBC. Quote, that said, if the transaction is successful, you might get some pressure with shareholders saying, how come Rio pulled this off and you couldn't with Anglo? I mean, surely these mining CEOs that are paid probably millions of dollars a month, surely they're not going to succumb to this kind of elementary questioning. Another headline, BHP is stuck on the sidelines of copper M&A frenzy it started. This is Bloomberg News via mining.com on January 12th. BHP Group's bold bid to buy rival Anglo American in 2024 was supposed to set it up as the clear winner in a copper boom it had long predicted. 2 years later, the copper market is indeed booming, and yet the world's biggest miner is left sitting on the sidelines of an M&A frenzy it began. People familiar with BHP's thinking said the news that Rio Tinto and Glencore are closer than ever to a deal that would leapfrog BHP to become the world's most valuable mining company has caused consternation within the Australian mining giant. However, some of the people played down the likelihood that it would respond with a move for Glencore, and said it's watching from the sidelines for now. Scrolling down, a merger of Rio Tinto and Glencore would almost certainly put the combined company out of BHP's reach for antitrust reasons. But Anglo Tech could yet be an attractive target if and when the two companies' merger is complete. Quote, it's not obvious that this is the only thing they've got. There are other things that can happen, said George Chevely, a portfolio manager at Asset Manager 91 and former analyst at BHP. Quote, to panic and pile in over the top of this one is not what you want to do. Couldn't agree more on that front. So interesting developments in M&A. Continuing on, U.S. urges partners and allies to increase critical minerals supply chain resiliency. This is Reuters via mining.com on January 12th, yesterday. U.S. Treasury Secretary Scott Bessent held a meeting on Monday with ministers from different U.S. partners and allies, urging those nations to increase their supply chain resiliency, the Treasury Department said. I'm kind of amazed that any government needs to be reminded of this at this point. Bessent hosted his counterparts in Washington, quote, to discuss solutions to secure and diversify supply chains for critical minerals, especially rare earth elements, the department said in a statement. A U.S. official said on Sunday that Bessent was going to urge those countries to step up their efforts to reduce reliance on critical minerals from China, which has imposed strict export controls on rare earths. Bessent expressed optimism nations will pursue, quote, prudent de-risking over decoupling, and that they understand the need to remedy current deficiencies in critical mineral supply chains, the department said. The meeting had representatives from Australia, Canada, the European Union, France, Germany, India, Italy, Japan, Mexico, South Korea, and the United Kingdom, the Treasury Department said. Together, they account for 60% of global demand for critical minerals. And then, it says last week, China banned exports of items destined for Japan's military that have civilian and military uses, including some critical minerals. I almost wonder, what did they really discuss there? Because I don't know if any of these countries need to be told that they need to diversify their supply chains at this point. It's all anybody's been talking about pretty much since April. Another headline, Orano may seek investors for $5 billion nuclear fuel plant in United States. This is Bloomberg News via mining.com. French nuclear fuel producer Orano SA said it may seek minority investors to help finance a $5 billion uranium enrichment plant that's planned in Tennessee. Orano was awarded $900 million this week by the U.S. government to build the facility, but it's still studying options for the rest of the funding required, the company said Tuesday. That may include equity and debt, as well as potential minority partners. The Trump administration awarded funds to 3 nuclear fuel makers as part of an effort to restart domestic production and wean the U.S. off Russian supplies. The move comes amid surging power demand from data centers and mounting pressure on politicians to tame rising energy bills. Continuing on, Lynas Rare Earth CEO to retire after over a decade in the role. This is Reuters via mining.com. Australia's Lynas Rare Earth said on Tuesday its chief executive officer Amanda Lacaze was retiring after 12 years, just as Western countries seek greater security of supply for the metals for which Lynas is the top Western producer. Lynas's board had already begun a search for a new chief to lead the company and would consider both internal and external candidates, Lynas said in a statement. Scrolling down, Lacaze's achievements have been, quote, spectacular, said Dylan Kelly of shareholder Terra Capital, pointing to Lynas's renegotiation of debt with its Japanese stakeholders, her attempts to get a North American plant going, and building a new processing plant in Kalgoorlie. Quote, she's one of the best CEOs I've ever come across, and she's so entertaining. It's salutations and congratulations. Really, she'll be sorely missed, he said. Another headline, pressure for Indonesia quota U-turn is a risk for nickel price rally. This is Reuters via mining.com on January 7th. Indonesia's plan to cut nickel mining quotas to boost revenues has succeeded in pushing nickel to close to 19-month highs. But analysts say pressure for a policy reversal is likely to mean the rally will be short-lived. Accounting for around 70% of global nickel production, which was estimated at around 3.8 million metric tons last year, Indonesia is the world's biggest nickel producer. Following its announcement of mining curbs in December, prices of nickel have steadily gained more than 30%. They hit $18,800 a ton this week, the highest since June 2024. It was last trading near $18,000. Continuing on, gold-silver miners sell stock at fastest pace in over a decade. This is Bloomberg News via mining.com on January 7th. Gold and silver miners last year raised the most cash through share sales in more than a decade, with smaller players leading the way as precious metals prices rallied. Last year, more than $6.2 billion was raised by companies listed on exchanges in the U.S. and Canada, according to data compiled by Bloomberg. That's the highest volume in at least the last 12 years, the data shows. And we have a quote from Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. Quote, these companies raise money not when they want to, but when they can, said Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. And final headline, China's central bank buys gold for 14th consecutive month. And you can read all the details of this Reuters article on mining.com. Those are your news stories. Now, let's take a look at metal prices. Turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.2%. That is 0.02% higher than last week. The UK 10-year gilt is yielding 4.37%, down 0.15% on the week. Italy's 10-year bond is yielding 3.45%. That is down 0.08% on the week. France's 10-year bond is yielding 3.53%. That is down 0.05% on the week. Germany's 10-year Bund yield is also lower at 2.82%. That is down 0.05% on the week. The Japanese 10-year bond is yielding 2.17%. That is 0.04% higher on the week, continuing its relentless climb. China's 10-year bond is yielding 1.85%, and that is down 0.03% on the week. So one wonders, with the U.S. yields perking slightly higher and European bond yields dropping, one wonders if this is a response on potential charges against Jerome Powell at the Federal Reserve. Turning to precious metals, gold is trading at $4,591.80 per ounce. That is $113 higher on the week, and earlier passing $4,600. Silver is trading at $84.90 per ounce. That is $6 higher on the week. Platinum is trading at $2,361.10 per ounce. That is $95 higher on the week. And palladium is trading at $1,922.50 per ounce. That is $180 higher on the week. So big moves higher in precious metals, turning to industrial metals. Copper is trading at $5.97 per pound. That is 4 cents higher on the week. Iron ore is trading at $108.25 per metric ton. That is $1.26 higher on the week. Aluminum is higher at $1.45 per pound. That is 5 cents higher on the week. Lead is also higher at 93 cents per pound. That is a penny higher on the week. Nickel is above $8 at $8.19 per pound. That is 35 cents higher on the week, so continuing its climb from $6.48 just 5 weeks ago to $8.19. Incredible. Tin is trading at $20.67 per pound. That is $2.34 higher on the week, so big move in tin. Cobalt is also higher at $25.53 per pound. That is $1.33 higher on the week. Lithium with another big jump, now trading at $21.80 per kilogram. That is $3.69 higher on the week, so almost 20% higher. Uranium is trading at $82.75 per pound. That is $1.10 higher on the week. And zinc is slightly lower at $1.45 per pound. That is a penny lower on the week. Zooming out, big picture, metals shoot higher on potential charges against Jerome Powell, and those are your metal prices. Coming up, I'm very pleased to welcome Jeffrey Christian, managing partner of CPM Group, back to the program, and we discuss the news at the Federal Reserve and the charges against Jerome Powell and the impacts on precious metals, as well as what happened in the silver market in the last month. Letting the smoke clear, why have prices gone so high and where it is going? So a wonderful discussion with Jeffrey Christian. I hope you enjoy it, and I will see you on the other side. Joining us today, I'm very pleased to welcome back to the program Jeffrey Christian, managing partner at CPM Group. Jeff, it's good to see you. It's good to hear you. Happy New Year.
Happy New Year. Best wishes for 2026. As I've been telling everybody, hold on to your hats. It's going to be quite a year. Yeah.
Yes, best wishes to all of us. Quite a beginning to the year. You know, massive events happening on a regular basis here. The big news, I would be remiss not to begin with this, of course, is the lawsuit against the chair of the Federal Reserve. We've seen gold and silver spike. I mean, we're talking today fortuitously on a day of, I believe, new records in gold and silver.
Yeah.
So since I have you here, Jeff, what do you make of this? What does this all mean?
Well, we're still trying to distill what it means. And, just for the record, he said that he wants an investigation of the cost overruns on the building renovation, and he's thinking about a criminal indictment against the Fed chairman. And, the way we're distilling it, you can get away with murder, as Mr. Trump has famously said he could, and he has in recent days got away with murder. But when you kill the goose that lays the golden egg, that allows for all of that, you've got a problem. And going after the Fed's independence is killing the goose that lays the golden egg, because the Fed has monetized the deficit spending of the government for more than a century. And it has kept the dollar strong, and it has kept the dollar vital to the global economy. And going after the Fed's independence puts the dollar at risk. And you saw about a 0.7% decline in the US dollar exchange rate on a trade-weighted basis this morning. But if you look at it against certain other currencies, it's off much more. You're really putting at risk the US economy, US industry, US manufacturing capacity, US competitive advantage, and the entire global economy. So we've been struggling with the potential of a recession emerging at some point. This increases that sharply. We are right now waiting to see what the three credit agencies say about potentially putting U.S. Treasury securities on credit watch for a further reduction in their credit worthiness, which would be a natural outcome of reducing or removing the Fed's independence. Now, people are saying, well, why didn't he just wait a few months in order to make a standard transition? Because Jerome Powell's term is up in a few months, and he's indicating that he's going to put some political hack in there who would lower interest rates inappropriately to replace Powell. And the answer is if he simply waited and made it a transition that was according to the policies and regulations and system, he doesn't create chaos. And what Trump wants to do and what he's been doing all along, this goes back to his private business days. He likes to create chaos and he likes to break things and he likes to diffuse the anger that people have toward him. So you've got the Epstein problems, and he's clearly been implicated. There are any number of women who came out and said that he raped them when they were underage, and that will come out. So you deflect that anger by doing other things like shooting civilians in Minneapolis or Oregon, or attacking Venezuela, or threatening to attack Iran, or bombing Iran, or supplying the bombs for Israel to bomb the Palestinians in Gaza, or threatening to take over Greenland and Cuba and Mexico and Colombia. He likes to create chaos. And as people get angry with him at things, he just throws out another hand grenade. So you think about Monday morning in Washington, D.C., and the Congress was going to get together and they were going to say, which of these problems do we deal with today? And Sunday night, he throws out a new grenade. It's like, well, forget Venezuela, forget Greenland, forget Iran, forget Minneapolis. We got to worry about the fact that he's taking aim at that which has allowed the U.S. government to do everything that it's done, good and bad, for the last 100 years. So that's how I take it. Right now, it's an extremely precarious thing. And yes, we saw a lot of investors moving out of cash, out of US dollars. They're buying gold, they're buying silver, but they're buying platinum, palladium, aluminum, copper. They're getting out of US dollars and they're putting their money not in the US stock market, which is off sharply as a result of all of this, but in tangible assets that probably are going to become more expensive because of the economic and financial issues that just got worse.
There's a lot there. And, I've been quoting actually what you've been saying in an earlier interview quite often. This is a bull market in real things. And it seems like real things are the safety trade to a certain degree right now. And this Federal Reserve story, to your point about him throwing out all these grenades, so to speak, and creating chaos, I think that's quite an apt description and quite astute description of what's happening. Because if there's one thing Trump really is a master of, it is narrative and news narrative, being in the tabloids for decades. And it seems like he knows how to manage the news, if not anything else. And so it's a very interesting analysis that you bring there. And just on the Fed story, in a sense, it's not just another story, as you opened up with there. We're still trying to distill what this all means because it's kind of gigantic in a sense in terms of the significance of what it means in terms of the credibility of the United States as a financial power.
Yeah. Yeah. This goes to the core of the US economy and to economic stability insofar as we have that. And you're now shaking the tree. And that can be very problematic, not only for 90% of the population, but also for the remaining 10% too, because they have wealth at risk now.
Now, we've seen new records here in gold and silver. Gold is at $4,639 as we speak on the CNBC COMEX futures. Silver is at $85.81, up 8% on the day, copper above $6. So perhaps it's self-explanatory, and perhaps we've even explained why these metals are up. But since you're so up close and personal with these markets, Jeff, maybe let's start with gold quickly, but then I really want to get a sense of what's happening in silver. I mean, what is happening here? Is this, you've mentioned it's investment demand is the biggest source. You mentioned the physical markets over the long term are the biggest source. Like, what is driving this right now? What are the flows doing?
It's primarily investment demand. You're seeing, and it's interesting because if you go back, I'm not sure the last time we spoke, but if you go back to the first 9 months of this year, first 8 months of this year, you saw a lot of investors buying gold and silver, but you also saw a lot of investors selling gold and silver. And there were stories about how dealers were having trouble. They didn't have enough money to buy the gold and silver that investors were coming in to sell them. So they had cash constraints and they had credit constraints. And then they didn't have sufficient buyers for all of that in the investment community. So they were selling it on to refineries, which then would have to melt it down and cast it into good delivery bars. And the refineries got all backed up. And you had this situation from, say, April through August where the refineries were backed up. They weren't buying scrap and other traditional refining materials because they had so much investment stuff coming in. One of the things that we've seen since November is that's stopped, and people have stopped selling so much metal, gold and silver, but other people have increased their volumes of buying. So you've had a surge in net investment demand, which reflects both an increase in net gross buying, an increase in gross buying, and a decrease in gross selling by investors. So the refineries are now back to normal in terms of their operating flows. But you've got this surge in investment. Now, a lot of the investment has been in ETFs and in futures, forwards, and options, which represents non-traditional gold and silver investors, momentum traders, shorter-term generalist investors. These are not people who want physical metal in a depository somewhere. They want to buy exposure to rising gold and silver prices, and they want to buy exposure to safe haven hedges in a time when the stock market's at a record level and is extremely vulnerable to a large downward correction. So you're seeing investment demand pick up really around the world, a lot of it in Europe and the United States, also in Asia, although the extent to which the Asian buying is not Asian based, but rather Europeans and US or North American investors is not exactly clear. But you're seeing investment demand strong around the world, and that's what's driven the gold price. The gold price was $3,400, $3,300 in early September. So it's risen, $1,300 since then. It's risen very strongly, and it's basically been investment demand.
Interesting. And the way you characterize it, it sounds like hot money, so to speak.
Yes, it can disappear very quickly. These are guys who are momentum traders, and when the price looks like it's plateauing, they're not going to say, okay, this is great. They're going to take their profits and go on to the next casino that they can find.
Indeed. And speaking of such casinos, let's move on to silver.
Okay.
Of course, what a Merry Christmas it was for silver investors over the holidays. So I'm kind of curious. I mean, we saw different stories come out. The news media, a lot of it was on vacation. So in a sense, you might say social media had a louder voice than it might normally have. And you're getting all sorts of stories on premiums in the Chinese market. Of course, the classic analysis that China is taking over the pricing. And perhaps this is true, which is why I'm asking you. The physical market, taking over the pricing in the physical market. Of course, the export controls that were from October, but all of a sudden they came out on Twitter, on X, but without the context that they were actually announced in October. And it sounded like they were just announced and China was making another move. So big picture, what on earth happened in the silver market since, December 15th?
Again, it's primarily been investment demand, and it's been a combination of long-term traditional silver investors and this influx of non-traditional, non-physical investors buying into the ETFs, futures, forwards, and options because the price has been rising. There has been this enormous increase in, you could call it marketing hype, you could call it misinformation. So, for example, you were talking about the Chinese. There were all these talks about China imposing export restrictions on silver for the first time. That's not true. Yeah, there have been export restrictions on China at least since 1949 when the Communist Party took over. And they've been much more stringent than they are today. And China has imposed some restrictions on exports and some tariffs on exports, but it's not necessarily anything dramatic. You've also seen two of the largest solar panel manufacturers in China say that they are shifting rapidly away from using silver in their photovoltaic panels. They're saying that they can make this change by the second quarter. So within 3 months, they can stop using silver. And solar panels have been the big growth story in fabrication demand for silver, going from virtually nothing at the beginning of this century to something like 220 million ounces last year. Our expectation had been that you were going to see this shift away from silver in solar panels starting to emerge this year and then accelerating next year. I'm just looking at our most recent data because it's changing rapidly. Our expectation now is that solar panels probably peaked in 2025, around 225 million ounces, and it could be off as much as 10% or almost 10% this year. So you're starting to see a combination of technological advances that allow you to use copper in newer types of photovoltaic panels and the effects of having the price at $85 an ounce or $86 an ounce, because again, as you said, I think, the price of silver was $29 at the start of this year or start of 2025. So the price has gone from, $30 to $85. That affects the economic profitability, not only of solar panel use of silver, but all kinds of other applications. Wherever possible, you're going to use silver-plated copper, or some other material rather than silver, given the sharp increase in the price. It's not a matter of availability. There's plenty of silver around to meet demand. And that selling by investors that I mentioned earlier through August has increased the amount of refined silver around the market. So you have enormous amounts of silver available for fabricators, but at high prices. And those high prices make new technologies profitable. You saw this in the 1970s. The silver price rose very sharply in 1973, 74. And the photo industry, which was the major user of silver, started doing research on what they call T-grain technology, which allowed you to use less silver per films and papers by laying the silver halide flat on the surfaces as opposed to upright. They didn't introduce that at the time because it didn't make economic sense to do that. But when the price of silver went from $5 to $50 over the course of 1979, all of the photo industry shifted to T-grain technology and sharply reduced the amount of silver they needed per unit of photographic products. So it's not unusual to see these technologies developed in the lab, but they're not financially or commercially viable until the price of the underlying raw material changes. And that is what's happening with silver right now, not only in photovoltaics, but in other applications. But you've seen all kinds of misinformation, the Chinese are banning silver exports. Well, they're not banning exports. They're just imposing some restrictions and tariffs on them. And, photovoltaic is using 400 million ounces, but it's going to use 800 million ounces. Well, no, it's not. And then there's all this garbage about how the Military uses much more silver than we estimate. And it's marketing hype by people who are selling silver to investors.
Regarding the $3 to $4 premiums that I believe I saw reported in Bloomberg at the Shanghai Gold Exchange, what do you make of that? Like, what is going on there? Why is it $3 or $4 more in China?
Well, China has a managed economy and it has certain restrictions on its futures exchanges that we don't have in the United States. The idea that silver would have additional landed costs, if you will, in China than it does in London or New York ought not to be surprising. The same way, that a car that costs $30,000 in the United States costs $200,000 or $300,000 in Singapore or in Shanghai. It's a different economy and it has greater controls. And there are import restrictions as well as export restrictions on the silver. It's not an open economy the way the United States used to be. So the idea of a $4 premium is not particularly surprising. Another thing that you keep hearing is like, there was a story a couple of weeks ago of silver was $130 in Tokyo. But when you drilled down and you said, well, what's the spot silver price for a 1,000-ounce bar in Tokyo? And, the spot silver price in the United States was like $80 and the spot price in Tokyo was $82. But there was this it was a small investor product that was particularly popular in Japan and had been sold out. And people were saying, well, I've got one, so I'll sell it to you for $130 an ounce equivalent. We're selling these things in grams or 10-gram sizes. So that then gets blown out of proportion. And, Japan doesn't have enough silver and the price of silver is $130. Well, if you want a 10-gram piece of trinket that everybody else wants, yeah, it's $130. But if you want a 1,000-ounce bar, it's $2 more than New York. But the marketeers will latch onto this kind of anecdote and push it on to people who don't stop to think about it. Another thing you hear is, oh, the silver market's in a backwardation. You say, no, it's not. If you look at the COMEX prices, there's no backwardation there. They go, oh, no. Yeah, you can't look at COMEX. You have to look at spot on Kitco versus the March active COMEX contract. And spot on Kitco costs more than a 1,000-ounce bar in a futures exchange that trades enormous volumes. Kitco is a refinery in Montreal, and its price is its price for silver in Montreal at the refinery, and that's its price. It's not the price set in a futures market that trades millions of ounces a day. So you can't go by a spot price. You can't even go by a spot price on COMEX because the spot price gets distorted by delivery patterns too. That's why everybody who's legitimate in their research of all commodity markets, they look at first nearby active versus the second nearby active to figure out the contango or backwardation, the forward spread. You tend not to look at the spot price because the spot price will bounce around much more. And that's why you also see regulations that are different for spot prices, spot contracts, than they are for forward contracts. So you see things, and these people latch on it, and they know that many investors are not going to say, well, is silver really in a backwardation? And it happens. And it's not just investors that they gully. When the London market stopped publishing forward prices and lease rates that were not reflective of the actual market in London in gold and silver, you used to see these calculated lease rates and forwards that were calculated based off of market prices, and they didn't reflect what was really going on. And it was a real problem because you would have negative lease rates, and people would call up and say, oh, I see that you can get paid 1% to borrow gold in London. I'd like to do that. I'd like somebody to pay me 1% to take their gold on lease. And say, no, you can't do that. The gold lease actually in London for somebody like you might be 3% or higher. It's not 1%. They don't pay you 1% to borrow their gold. And, the government regulators sort of said, hey, you got to do something about this. So the banks stopped quoting that. once you stop quoting that, then it's like, well, the gold market's in backwardation. And we had CEOs at major gold mining companies saying, is London in backwardation? And we said, no, it's not. And well, how do you have any data to prove that? It's like, no, I don't. Because the forward price is determined by the market plus the creditworthiness of the borrower, right? So if you're a central bank, you're going to have a different forward price than if you're a bullion bank trading interbank. And they're going to have a different price from a major gold mining company, which will have a different price from a smaller gold mining company, which will have a different price from an investor. So you went from having bad data on forwards and lease rates in London to having no data. And that then opens the door for marketeers to say whatever they want. Because who's going to prove them wrong? The only way you know what the forward price is to be in the market and ask your seller for a quote on a forward price.
Okay, so we saw the CME, they raised their margin requirements. I thought I saw 3 times, but I only saw in a news report twice.
Mm-hmm.
What is your sense of the physical stocks, say at the LBMA, at the COMEX in Shanghai? Like, is it lower than usual? Is there a shortage of silver, so to speak, or is this inaccurate?
Well, on the COMEX, inventories are around 460 million ounces. I'm just looking to grab the most recent price that we have in our report. Silver inventories on COMEX are at near record levels. If you go back 2-3 years ago, inventories were a couple 100 million ounces. They rose sharply and they reached a peak of 530 million ounces at the end of September. And at the end of December, they had dropped to 449 million ounces. But that 449 million ounces is about 4 times more than the COMEX silver inventories traditionally were. And, we've put this in some of our videos and some of our reports. It's in all of our reports. In terms of London, you had a lot of silver that came out of London earlier and came to New York, which is one of the reasons why New York inventories are at record levels or near record levels. And some of that has gone back. So you saw COMEX inventories go from about 850 million ounces in the middle of 2024. They dropped to about 709 million ounces at the beginning of this year. And now they're back up to 850 million ounces, which is basically where they were from 2022 through the middle of 2024. So there's plenty of silver around in London and in New York, the two major international markets. Mumbai and Hyderabad are tighter. Investors who regularly sold silver scrap into the Indian market have been holding back because of record prices, and they want to see how high the price could go before they sell. So that has tightened the silver bullion market in India somewhat. And the market seems to be very well supplied in China at present. So there doesn't seem to be a physical tightness.
Very interesting. So, as we wrap up here on silver, then, Jeff, what should we be looking at right now in the silver market? What are you looking for? What are you paying attention to as we see, these prices at $85, $86 an ounce?
It really comes down to investment demand. I mean, obviously, we're looking at mine production, secondary recovery from scrap, and we're looking at fabrication demand. We're looking at the auto industry because the auto industry uses about an ounce of silver per car. So if they reduce their auto sales by 1 million cars a year on a global basis, that's 1 million ounces of silver demand that doesn't occur. So we're watching the various industries that use silver because they're very important. Batteries, electronics, auto electronics, general electronics, computers, solar panels, and other applications for silver. We're watching that. But in terms of the price has increased because investors have been buying increased amounts of silver since the end of August. So we're paying a lot of attention to the various metrics on investment demand, because if investors stop increasing the volume that they're buying, the price comes back off.
Very interesting. And your story about the photographic film industry in the 70s is quite an interesting one, because it seems once these industries make the shift and all of a sudden their costs drop, it seems unlikely that they're going to go back to former ways.
Yeah, exactly. I mean, the T grain technology stayed in place, and insofar as people are still producing films and papers that use silver halide technology, they still use the T grain technology. You don't say, oh, the price is back down, so I can reduce my profitability and squander more metal. Once you put in that new technology, it's in place. The same way, like a scrap industry, scrap industry has installed capacity and it needs to feed that refinery. If you're running a refinery at 50% capacity, it's not as profitable as if you can run it at 70 or 80 or 90% capacity. So they don't necessarily shut down their refineries when the price falls. They'll shut down their refineries if the flow of metal falls so low that they can't operate them profitably. But, you've got installed capacity. You've got installed capacity in fabrication demand. And, you're looking at companies like auto companies or people who make architectural glass, and they'll use silver in reflective glass and in mirrors and brazing alloys and solders and a host of other products. And they use that silver to make those products. And they're going to continue to make products as long as they can do so profitably. Yeah. And in most of those applications, the price of the silver content is relatively small relative to the price of the final product. It's only in jewelry and silverware where the value of the silver contained in the final product is a large percentage of the price of the final product. So those are, jewelry and silverware are more price sensitive. But other fabricators, they're in the business of making stuff, not investing in silver. So they're sort of wedded to continuing to use silver as long as they can do so profitably.
We're seeing, to your earlier point, this move in the metals across the board. I mean, lithium at $20 a kilogram, copper above $6 on the COMEX futures, nickel above $8 a pound, looking like it's bottomed. Is there a metal that catches your eye right now? It's hard to tackle everything. Do you have any general thoughts? And is there a metal that kind of is standing out to you?
Well, I think gold and silver are standing out in my mind, partly because that's where I spend most of my time. And they are financial assets. But, what you're seeing across these markets, you're seeing stronger demand from fabricators. Most of these are industrial metals and they're being used. And you're seeing relatively strong demand for now in the industries that use them. But you're also seeing inventory building by fabricators, by trading companies, and others, as well as investors. And that is this whole thing of I don't want my money in the US stock market, and I don't necessarily want my money tied up in US dollars. You have like 20% of the world's financial assets, private financial assets, in US dollars in cash, not particularly earning a great return, but exposed to a downward flush in the dollar. And the dollar is off about 6% from where it was a year ago. And there are people who think it's going to move lower. So there's this move away from the dollar into things, into stuff. And those raw materials, metals that don't rust, metals are better than agricultural commodities because agricultural commodities, they have a finite life. But the metals, generally speaking, are around. Those metals are very attractive. They're attractive partly because they're not dollars and partly because they will ultimately be needed by industry.
As we wrap up here, Jeff, a bit more of a provocative one here for you. Some people are referring to what we're seeing out there with this increased attention on resources and resource scarcity and what we see with Greenland, even Venezuela. Are we entering a commodity war of sorts, or is that an overstatement?
I think it's an overstatement. There is some commodity resource scarcity, and there's definitely increased commodity and resource nationalism, where governments have said, hey, we're producing this metal and we're getting a low price for it. So there's resource nationalism, but there's also economy building where, you see around the world, not just with metals, but other things like, for example, in cocoa, the cocoa market has shifted dramatically over the last 20 years because countries that used to grow cocoa and then ship it to Europe or the United States for processing into cocoa and chocolate are now building, or not now, but 10, 15 years ago, were building processing plants in their countries. And you're seeing the same thing with industries that use metals. So you're seeing Brazil and other countries say it's one thing to be producing copper and iron and tantalum and other raw materials. It'd be even better if we can increase the beneficiation by taking those raw materials that we traditionally produced and make them into semi-fabricated, if not fabricated products. And that then tightens the supply relative to demand because all of a sudden you have new manufacturers. The problem is that you get into overcapacity situations. So if you go back to solar panels, the solar panel industry has exploded over the last several years around the world and is now operating at about 50% capacity utilization. You can't be profitable at 50% capacity utilization. There are a lot of solar panel factories that are probably vulnerable to closing. Similarly, lithium ion batteries. You've had this tremendous growth in lithium ion battery manufacturing capacity. You still have tightness of supply for the raw materials and the semi-fabricated materials that go into the lithium ion batteries. And you also have more capacity than you have demand for finished batteries. So that whole battery industry, A, sucks up raw materials and drives the prices higher, but B, is vulnerable to rationalization, which could sharply reduce the amount of purchases of raw materials for inventories for fabricators.
Okay, and final question, just briefly, if you can. Do you think we've seen a bottom in the battery metals?
I think we've seen a cyclical bottom. I'm not sure that we've seen a permanent bottom. And I think, the battery technology has a lot of new technologies coming along that could radically change things in terms of what your battery contents are. There's a lot of people looking at solid state batteries, including solid state batteries that use silver, but building the capacity, you can't take a factory that's making current lithium ion batteries and make solid state ones. You have to radically re-engineer it, so there's extremely high capital costs. Meanwhile, there are other people who are working with wet lithium ion technologies, and they're finding ways to make them safer or more powerful or both using the same installed capacity that already exists. So the battery industry is a place where there could be massive swings in what raw materials you need and how much raw materials you need. And then on top of all that, you have the uncertainty of future demand for electric vehicles.
Whenever I talk to you, Jeff, it's like I come to the realization that, we all want simple answers on these things, and there are no simple answers. So thank you again for joining us today on another historic day in the gold and silver markets. Jeffrey Christian, Managing Partner at CPM Group, thank you for joining us.
Always a pleasure.
Thank you once again to Onion for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit onion.com. Also, thank you to Jeffrey Christian for appearing on this week's show and sharing his insight as ever. And also, thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.